folks, and welcome into today's video. So this is the ultimate Tattooed Chef Ttcf stock video here. We're about to go through their earnings. I'm going to take you through all the numbers, show you those, okay? Now, I've already seen the numbers here today, but actually what I'm going to do for the first time is listen to the earnings call, and we'll listen to that together. And this is my first time listening to it, so we'll see what comes out of this conference call. I'll stop it at any points where I want to make an opinion on something that is said there, and we'll kind of go through that. So yeah, I hope everybody enjoys this as always in the Tattooed Chef squad. Anybody that's, if you don't own this stock, this is a stock I own personally because I'm a huge believer in the plant-based movement that is happening over the coming decades. And Tattooed Chef is one of the best positioned companies, in my opinion, in that space. And so I'm obviously putting a lot of chips on the table there. Everybody that's already in the TTCF squad, you know this. This is a stock that I'm planning on buying this entire year, essentially, and just continue to accumulate more and more shares and add to my ownership position of this company, being that they're in the forefront and a leader in a space that's just going to grow massively over the next, several decades, in my opinion. So, alrighty, so let's go through these numbers here. First off, record 2021 full year revenue, expanded manufacturing capacity, and national retail presence. And they provided 2022 guidance, which I'm pleased at. There's a lot of companies that aren't giving 22 guides because essentially it's a very confusing time, obviously, out there with everything that's going around. So even though the Tattooed Chef's a smaller company, I definitely appreciate that they feel confident enough in their business to give that 2022 guidance, because I can tell you there's not a lot of companies that are doing that right now, okay? Now, in terms of this last quarter, they reported revenue rose 32.2% to $52.3 million. So analysts were expecting $51.07 million of revenue. So they beat by about $1.2 million of revenue there. Analysts were expecting revenue growth to be at 29%. They came in with 32%, so it was a very, very nice beat. And I did a video last night, essentially, on why I thought, they're probably going to end up beating. And sure enough, they ended up beating by about a little over 3 percentage points. So that's a pretty nice beat. Not like crazy, like, oh my gosh, this is like earth-changing type stuff, but that's a solid beat when you beat by more than 3 percentage points there. Tattooed Chef branded revenue increased 21.7% to $29.2 million, or 56% of total revenue. Net loss came in at $13.1 million. Adjusted EBITDA loss was about $11.4 million, as to be expected with this company and its particular growth stage where they're at. That's to be expected. This isn't the type of stock that you should expect short-term profits in or something like that in terms of their net income line. There's plenty of food companies out there that are, old school companies with almost no growth, but they're profit machines, such as Tyson Foods, Conagra Foods, and many other various companies in that space. So I'm on this because it's a game-changing company that has, ridiculous growth over the next 5-10 years, not because they're making short-term profits or anything like that. 2021 full year fiscal overview compared to full year 2020 numbers, right? Revenue rose 43.7% to a record $213.4 million there. That is a beat versus what analysts were expecting. Tattooed Chef branded product revenue increased 56.7% to $132.5 million, or 63% of total revenue. Now, in terms of this latest quarter, when it comes to branded revenue, that wasn't as impressive, mainly because they didn't do much club business, and that was a huge component of their business last year in the same quarter, essentially. So, nonetheless, I expect the branded revenue to re-accelerate the growth levels in Q1 and in Q2 there, okay? At least that's my expectation. Net loss, $87.4 million. Acquisitions, it was kind of a messy year because obviously acquisitions and those sorts of things, they closed 3 different acquisitions in the year. And whenever you're doing those sorts of deals, usually it's going to cause you to lose more money. Adjusted EBITDA came in at a loss of $26.1 million. Expanded the year with 78 branded SKUs. That's different products, essentially, up from 38 branded SKUs at the end of 2020. One of the things that makes me so confident about the Chef is how rapidly this company continues to innovate. I've never seen a company in the food space, to be honest, in the 14 years I've been doing this, that is expanding as rapidly as they are and innovating as rapidly as this company is. Expanded branded distribution to more than 160 retailers with approximately 14,000 locations, up from 4 retailers and approximately 4,000 locations at the close of 2020. So that's just tremendous progress. Basically, they're landing and expanding. Landing and expanding, what that means is getting in new retailers and then getting more SKUs in those actual retailers. They acquired the New Mexico Foods distributors, which is an asset at certain liabilities, the Belmont Confections, which together added 3 new production facilities and accelerated the company's entrance into raw product categories and provided scale for future margin acceleration, accretion, which, just better margins. That's the best way of putting it, okay? And no doubt as they get out of just being a frozen food company and into other adjacent spaces, their margins will continue to increase and increase and increase. And as this business scales, they're going to get smarter about how they manufacture, how they do their products and those sorts of things, and margins will continue to go up in future years. In 2022, in my opinion, the margins will be far better than 2021. In 2023, the margins will be far better than 2022. It's a company that year after year after year, not only is it going to be a huge growth company, but the margins will just get better year after year after year, in my opinion, okay? Outside of that, they launched their first national media campaign to elevate brand awareness and drive sales. 2021 was a milestone year for Tattooed Chef, said Sam Galletti, the president and CEO. We grew our revenue by approximately 44%. They had 2 transformational acquisitions. They expanded national presence, diversified our channel and customer mix, and broadened our product line. That these financial and operational achievements were realized against a backdrop of supply chain stresses and pricing pressure is a testament to our team, the resilience of our vertically integrated infrastructure, growing interest in our plant-based offerings, and validation of the investments we're making in our people, products, and processes overall, okay? So here they just kind of go more into detail with the numbers and things like that. A few other things I want to point out here. So one is their financial condition. At December 31, 2021, cash and cash equivalents was at $92.4 million. They had a total debt of approximately $700,000. So they're cash loaded to the sky right now. So I'm obviously very, very happy with that. And they're obviously spending on the business so they can get more lines and their production up and rolling in a much bigger way. So definitely happy about all that. For the outlook, this is very, very key. This part is extremely key. Revenue, they're expecting of 280 to 285, which is right in line with what analysts were expecting. Analysts were expecting, as far as revenue goes, 282, okay? So right around the, exactly what analysts were expecting. Now, how did they get there? Driven by a combination of new product introductions and an increase in retail distribution via new relationships and penetrating existing accounts compared to 2021, and contributions from acquisitions that were done obviously in 2021. Also, I'm expecting, sell-through to be even better this year. Now the brand's going to be even more well-known a year versus a year ago. They're expecting gross margins of 10 to 12%. I think they're lowballing that number. I'll just put it that way. I'm expecting gross margins to be anywhere from 12% on the low end to actually about 15% for full year. In my personal opinion, this is my personal opinion, okay? Take it for what it is. I've seen a lot of companies come and go and numbers and how these folks do things. So let's keep in mind, Tattooed Chef disappointed in 2021 when it came to growth metrics. They basically overpromised and underdelivered when it came to their revenue growth, right? And it hurt the stock price. Obviously, all small caps were hurt, but this was just another reason for the stock to be hurt, right? Now, going into this year, I think they're actually setting themselves up to surprise to the upside throughout the year, where I think they're gonna have really, really, really good numbers throughout the year and better than what management's putting out there now. This is something that happens on Wall Street, where a lot of times companies, especially if they come off a tough year, they take it a little more conservative as far as their guidance goes. It's a smart way of doing it. It's a smart way of doing it because there's nothing worse that Wall Street hates, that shareholders hate, than being disappointed on growth expectations, especially when you're a growth company. They love it when you come in with those beats and it's like things are even better than we anticipated. And so when I look at this company, I think they're probably lowballing a little bit. They have marketing expenses expected at 27 to 32 mil. The capital expenditures of approximately $20 million with investments focused on automation, robotics at their manufacturing facilities, which is obviously those are the type of things that, you spend money up front, but obviously it's going to help your margins and help you become much more profitable down the road, especially in a tight labor force where wages are going up substantially. So overall, I was happy with the numbers. And I'm excited for the future of this company and kind of where they go from here. So now let's go ahead and listen to the conference call here and give that a listen, and then we'll keep rolling, okay?
Full year 2020.
Whoa, I don't know what happened here. What in the world?
Increased manufacturing.
Oh, let's back it up.
Obligation to update any forward-looking or other statements herein whether as a result of new information, future events, or otherwise. In addition, within the earnings release and in today's prepared remarks, adjusted EBITDA is referenced. It is important to note that this is a non-GAAP financial measure that the company believes is a useful metric that better reflects the performance of its business on an ongoing basis. A reconciliation of this non-GAAP financial measure to its most directly comparable GAAP financial measure is included in today's press release, which has also been posted to the company's website. With that said, it is now my pleasure to turn the call over to Tattooed Chef's President and CEO, Sam DeLay. Sam, please go ahead.
Thank you, Devin. 2021 was an exceptional year for Tattooed Chef, highlighted by record revenue, an increased manufacturing footprint, a broadened distribution base, and an expanded and innovative product line. We achieved our revenue guidance that have entered 2022 with a great sense of optimism. Briefly, fourth quarter revenue of $52.3 million helped us generate full year revenue of $213.4 million, up 43.7% from 2020, and driven by 56.7% increase in branded product sales to $132.5 million, or 63% of total 2021 revenue. I am very proud of our team and the results that we were able to deliver in a challenging environment of supply chain constraints and inflationary pressures. Although our gross margin was impacted by significantly higher freight and container costs, we believe that our vertically integrated operating model
that freight and container costs is killing them right now. When it comes to any short-term profitability, it's making all their numbers look much worse than they really be, right? Freight and container costs, that's not going to stay elevated forever. I can promise you that. That's a commodity, and that will come down, and that will make Tattooed Chef go from this massive headwind hitting them and hurting their profitability in a huge way to actually moving to a tailwind and actually help the company's margins look even better and better and better over time, and obviously helping the company get much more to that stage where you're about to flip to profitability. But for right now, it's hurting them massively in the short term. But at the end of the day, that stuff goes away. So
that much of which we manufacture, we grow, has helped us weather some of the more severe consequences of this unprecedented operating environment while providing us with important and sustainable competitive advantages. Rather than focus on what we can't control, we have devoted our resources to managing those things that we can. By adhering to the principles of product innovation, distribution, marketing, and strategic M&A, along with a long-term focus of mixed diversification from private label to branded and frozen to ambient, we are confident in our ability to generate continued growth, expand our margins, elevate our brand profile, and deliver value to our shareholders. We ended the year with a much more diversified base of customers. Tattooed Chef is now available nationally at the club, mass and grocery, and establishing a presence in food service industry. We broadened our product distribution and diversified our channel mix to include 160 retailers covering approximately 14,000 locations, including new blue chip names like Target, Kroger, Publix, H-E-B, Albertsons, Safeway, among others. It's important to remember that our success in establishing a presence in these locations is not an end in and of itself, but an important incremental step towards capturing a significant sales growth opportunity. While the breadth of our national footprint is important, it is the depth of our presence, represented by the introduction of new SKUs into existing national distribution points, that will help drive our growth.
That's the most amazing thing for me with this company. One of the reasons I stay so confident in it, and one of the reasons I want to just buy the stock throughout the year, is essentially this is a company that no one ever heard of this company 18 months ago. And in the last 18 months, they've landed every single big retailer you could possibly want to land. And that's extremely challenging. Like if you've ever been in the food business or drink business, try to land every single company out there, every single big food retailer that matters. And good luck. You'll be lucky if you can get one big account, never mind basically every single one out there. So it's been amazing what this company's done. And it's another reason why I'm confident that once the company goes more international, they'll have success there as well. They know how to get in those retailers. They know the metrics to show them, and they move product.
At the end of 2021, we expanded our total doors to over 14,000, our total distribution points to over 100,000. We view this as a significant accomplishment when considering we exited 2020 with just over 4,000 stores and 23,000 points of distribution. We are continuing to pursue the significant organic growth.
So almost a 5x on points of distribution. And we're talking about almost a 4x in the amount of stores. That's incredible. In a 1 year span. That's the biggest thing, in a 1 year span.
And have a long-term goal of having 30 frozen SKUs in each retail location. The channel diversification and broad...
Ooh, that was big. A goal of 30 SKUs in retail locations. That's something I talked about a while back, where I was covering just their frozen business alone. Okay, not even talking about ambient products or which are like non-refrigerated freezer goods or refrigerated products, anything like that. I was looking at it just from the freezer standpoint. I think this company can have 30 SKUs easily within the next year or two in a lot of the biggest retailers out there in the food space. When I count up at a lot of these stores, how many different SKUs they have, when I talk about other big brands in the space, it's very common for 30 to 60 plus SKUs. A lot of these other big companies have in a major retailer. And so for me with Ttcf, like with the type of velocity they have in their product, there's no question in my mind that they can't get to a place where they got 30, 50, 70 SKUs just in the freezer aisle alone. Never mind, other products around the store.
Distribution is manifesting itself in the consumption data as measured by SPINS IRI. Ttcf's year-to-date growth performance through 12/26/2021 in MULO is extremely encouraging. We are the fastest growing health and wellness brand in the categories in which we compete, which include frozen appetizers and snacks, breakfast, entrees, and vegetables. For example, in frozen breakfast, we grew retail dollars 496% and are the number one health and wellness brand as measured by SPINS and the fastest growing. In the frozen entree category, Ttcf is now number 7 ranked health and wellness brand and growing the fastest of the top 30 brands in the category. Frozen entrees is by far one of the largest categories in the aisle, and we clearly have momentum and are taking market share.
That's crazy. They're already number 7 in that category. And once again, no one ever heard of this company 18 months ago. So to go from no one ever heard of you to the number 7 already, like that quickly, it's just a matter of time before they go top 5, top 3, and then maybe number 1. It's incredible.
We also view innovation through the lens of expanding product accessibility, which is why we are so enthusiastic about our upcoming entrance into ambient and refrigerated plant-based products to complement our growing position in the freezer aisle. In that regard, I am pleased that the integration of the acquisitions we completed in 2021, Foods of New Mexico and Belmont Confections, is proceeding on track and provides us with substantial capacity to introduce new products. We believe that our investment thus far to upgrade the facilities, increase automation, will allow us to dramatically increase throughput and meet anticipated demand for these products. This will support our efforts to unlock greater shelf space and expand our channel penetration beyond retail and club. With respect to Foods of New Mexico, the Karsten facility is scheduled to open during the beginning of the second quarter with an initial focus on manufacturing a variety of salty snacks. The Albuquerque facility, which produces Mexican foods...
a variety of salty snacks. So, yeah, they got some sort of products that are going to, I'm sure, show up out there. So maybe some leaked images that might come out over the next few months. So what that means, maybe it's chips, maybe it's some sort of tortilla chips. We'll have to see, but that's exciting.
Quesadillas, burritos, and other handheld items and sauces has commenced manufacturing Tattooed Chef branded products. These products began shipping to Kroger earlier this month, and we expect further distribution throughout this year.
I got some at my local Fry's last night, which is owned by Kroger, and I got to try out a few. Very good. Only problem is, like all frozen burritos, like the ends of them get hard, and I hate that, man. But that's all frozen burritos. But the inside is very, very good.
Belmont Confections, which we acquired in December 2021, has even more capacity, allows us to produce a variety of bars. We are currently co-packing out of that facility and will begin transitioning to Tattooed Chef branded bars beginning later this quarter. Our inaugural entry is a first-of-its-kind brain fuel oat butter bar powered with adaptogens that help to reduce stress, promote mental balance, and provide long-lasting focus. This product was featured at Expo West, and samples were shown to attendees, including buyers at the show. We are expecting shipments to be ready during Q2, and I want to emphasize that our branded products will carry higher margins than our current co-pack products. The addition of these facilities and associated capital project investments has increased our total manufacturing capacity to more than 315,000 square feet, a fourfold increase from 2020. They are also expected to support up to an additional $300 million in annual revenue in the next 2 to 3 years. We are also investing in cold storage solutions to further strengthen our process and production to reduce associated costs.
As far as if you're thinking about like peak losses, the worst margins, those sorts of things, I look at that as 2021 was the peak loss year, peak negative margins or bad margins, those sorts of things. 2022, I expect just progress to be made. 2023, I expect them to start hitting profitable quarters. Maybe not quarter in and quarter out, but even if they don't hit profitability in a quarter, they'll be like very, very close to that essentially, and then just continue to make progress 24, 25, and so it's going to be fun kind of going from like worst case scenario to things just continue to get better and better and better over the coming quarters and years.
We have contracted a lease for cold storage in April and expect to begin raw material storage in the coming weeks with full product storage and pickup opportunity. This is a beautiful turnkey facility. We estimate that these initiatives will produce an approximate 50% annualized cost savings as compared to using third-party storage units for the refrigerated and frozen goods.
Wow, 50% savings for the cold storage. That's massive. So that's another one of those, that's kind of, I think it's such a wrong view how a lot of folks are looking at this right now, because they're looking at it as like, some folks, I think the bulls understand the game, but I think a lot of the bears or just the pessimists around the stock, they look at it and they just get so caught up in the short-term margins or profitability, and they don't understand how young this company is. And I just wish some of these folks had ever built a business themselves, because they would know, like, this, in order to scale this rapidly, you're not going to be able to focus on profitability. You're just trying to get the product out to the shelves as any way possible. And as a company gets more and more mature over the coming years, you start finding out, okay, we're doing this kind of dumb. We need to do this a little smarter. Oh, we can save some money over here. Oh, we can have it, And the best part is those cost savings are the most epic in that first few years of you starting to even be able to focus on that. So 2022 is kind of this first year where they're even able to like contemplate taking some of these cost saving initiatives, right? And then 23 and 24. And, when you're talking about a 50% cost savings, that's insane, okay? Other businesses, more established, mature ones, it's like if you could save 2%, you're winning. For something like Tattooed Chef, like they're in that stage because they have so much savings where they can all of a sudden just change the game. And it reminds me of like Tesla back in the day. Tesla, it used to be like, oh, Tesla's going to go bankrupt. Look at how bad their margins are. Look at how much big their losses are. And it's like, dude, they're going to figure it out. They're going to figure out all the ways to produce the cars a lot cheaper. And that's obviously much more complicated than something Tattooed Chef has to deal with. And they did it, right? And they figured out, okay, we're going to do this, do that. We're going to figure out a way around this, right? Revenue growth solves all, and just constant focus on, bring down those costs is what matters.
Point of reference, in 2021, we spent more than $5.8 million on cold storage. Perhaps most importantly, we expanded our team of professionals to help support.
Wow, $5.8 million they spent in 2021. So if you're talking about 50% savings, do the math on that. It's beautiful.
Growth this year and beyond. We welcome Gaspar Barassi as Chief Operating Officer in late 2021 to lead our global operations and production, with a current emphasis on robotics and automation. We have also added a Director of SEC Compliance and Technical Accounting, Director of SOX Compliance, Vice President of Sales and Support Logistics, and Vice...
Good. So not only are they adding people on the operational team to help this company continue to save more money moving forward, get the margins in place, and expand more rapidly, but also they're putting they're getting a legit accounting team, and so they don't have any issues like they had obviously in 2021 where they had trouble getting the numbers together and those sorts of things. So I'm very pleased as a shareholder of this company to hear that they're making those sorts of steps. That's great steps in the right direction. So that I will say about that. And all those things, right? Those are all big costs in the short term. They hurt your profitability. But at the end of the day, when you're a generational type company like Tattooed Chef, you have to make those investments because the world is theirs as long as they execute, right? And stuff like that can throw you completely off if you have any accounting problems, if you don't have the right executives in place to help you expand and bring down your costs and things like that. Your whole process can get messed up. So it's brilliant that they're spending up front so they can kind of do their thing over here in the future years.
For all of the manufacturing facilities in the United States. It's been an exciting and productive full year as a public company, and I want to thank each of you for your continued interest and support. We have accomplished a lot, and we have learned a lot. And although our story has many chapters to be written, I am confident that we are well positioned to achieve our objectives and deliver shareholder value. I'd like to turn over the call to Sarah to discuss our innovations and marketing initiatives. Sarah?
Thank you, and good morning, everyone. As we proceed with our vision of creating a new food category, we are very excited to achieve continued diversification within our product portfolio over multiple categories and find new ways to expand our presence and our multidimensional brand. We curate our product line with the overarching goal of creating better for you foods coupled with the familiar foods we know and love. We call it nostalgic innovation. Through 2021, we added 40 new delicious and innovative creations, more than double the product introductions in 2020. Looking at 2022, we have a pipeline of more than 250 new products, including the upcoming introduction of our refrigerated plant-based bars, a range of Mexican items, and wood-fired pizzas. We continue to see growing consumer interest in plant-based foods, and in the last year, our products have performed consistently well in the market. Within the single-serve plant-based frozen entree space, we hold 6 out of the top 10 products. Innovation has been a key growth driver.
Wow, 6 out of the top 10 products. That's insane.
Tattooed Chef brand. We nearly doubled the number of branded SKUs to 73 and expanded from 5 product categories to 7. Our marketing efforts ramped up later in the year, and we continue to test and refine our playbook, making a concerted effort to diversify our media mix and appropriately allocate our spend to promotional efforts that align with our brand and our target customers, including YouTube, Spotify, General Market Network TV, programmatic connected TV, as well as social channels such as Instagram, where consumers are highly engaged with our brand. We focused our spend and tested them in various regions. They were strong performers, giving us a really effective return on ad spend and amplifying the growing organic reach that our social platforms and product packaging efforts create for the brand. In Q4, we strategically shifted our social media aesthetic to present ourselves as an all-encompassing lifestyle brand. We're focused on showcasing real and authentic moments, whether that be of people enjoying our innovative plant-based foods or jamming out to our latest Taste of Jam Spotify playlists. Our main goal is to connect with our audience and in a way that is different from other brands, which means showing up differently on purpose. We believe that we are just scratching the surface. As a leader in leveraging marketing tools, we are driving new consumers to our brand, to the freezer aisle, and to our retail partner stores. In 2022, you'll see us accelerating with our most aggressive marketing to date to build consumer awareness and engagement. This will allow us to expand our community and build loyalty to our Tattooed Chef brand and our evolving product line. With that, I will turn it over to Stephanie to review our financial results. Stephanie?
Thanks, Sarah, and good morning, everyone. Revenue in the 2021 fourth quarter increased 32.2% to $52.3 million from $39.6 million in last year's fourth quarter. The increase was due primarily to a 21.7% rise in Tattooed Chef branded product revenue to $29.2 million from $24 million in last year's fourth quarter. For the quarter, branded revenue accounted for 56% of total revenue compared to 61% in the comparable prior year period. During 2021, we began offering new promotional programs on sales of Tattooed Chef branded products to some new and existing customers. As a result, as of year end, we have accumulated an allowance from 2021 sales for promotional programs of $4.13 million. Gross profit in the fourth quarter was $1.1 million, or 2.1% of revenue, compared to $4.4 million, or 11.1% for the prior year period. Full year 2021 gross profit was $22.1 million, or 10.4% of revenue, as compared to full year 2020 gross profit of $21.7 million, or 14.6% of revenue. The gross margin decline for full year 2021 included the additional promotional allowance mentioned above and freight and container costs of $31.3 million compared to 2020 costs of $18.4 million.
Ooh, over $30 million of freight and container costs. That's vicious.
An increase of 70.5% or $13 million. Gross profit also reflected the impact of lower margin, private label, and co-packing products.
And the tough thing about that is there's nothing, Tattooed Chef could have done short term to have solved that problem. That's just something they had to deal with, obviously, in 2021. The good thing for the company is they're not at that stage where they're really judged on profitability yet. That's the one good thing for them. But man, that's horrible.
Being produced at our recently acquired New Mexico and Belmont confection facilities, partially offset by higher revenues and improved production capacity. We expect that gross margin will be positively impacted as we transition the acquisitions in both New Mexico and Ohio from private label co-manufacturers into manufacturing Tattooed Chef branded products. This, combined with the expansion of products into refrigerated and ambient space, will provide increased margins. We will also be making investments in equipment for our frozen products of $20 million that will increase our production capacity, improve yields, decrease labor costs, and allow us to remain in our same manufacturing footprint. Operating expenses decreased to $14.8 million in the fourth quarter of 2021 compared to $19 million in the prior year period. The decrease in operating expenses was primarily due to merger-related bonus, stock plus cash, approximately $13.6 million incurred in the fourth quarter of 2020, offset by the higher sales and marketing costs spent in 2021, which we view as important investments in our continuing growth. As Sarah mentioned, we believe that these investments have helped drive revenues and establish the foundation of a recurring, loyal customer base to support our planned new product introductions this year. The loss before provision for income taxes was $13.5 million compared to Q4 2020 income before provision for income taxes of $23.5 million. In Q4 2020, the company recognized a non-recurring gain of $37.2 million on settlement of a contingent consideration derivative liability related to the holdback shares, which were remeasured with changes in fair value. Income tax benefit was $0.4 million compared to an income tax benefit of $42.1 million in Q4 2020. The 2020 income tax benefit was resulted from the merger transaction that had step up in the tax basis of intangible assets and the change in tax status from an S corporation to a C corporation. With respect to 2022, we believe that income tax will be aligned with our operating results. Net loss for the quarter was $13.1 million compared to net income of $65.6 million in Q4 2020, which included the above referenced $42.1 million income tax benefit. Adjusted EBITDA loss was $11.4 million compared to adjusted EBITDA loss of $1.7 million in Q4 2020. The quarter-over-quarter variance was due primarily to lower gross profit margins and higher sales and marketing expenses, as we discussed earlier. We continue to maintain a strong financial position. At December 31, 2021, cash and cash equivalents were $92.4 million, and long-term debt was $0.7 million. Net cash used in operating activities was $51.3 million for full year 2021, compared to net cash used in operating activities of $13.4 million last year.
One of the other great things about obviously Chef is that financial position, right? Because they've been in such a strong financial position, so cash loaded, it's gotten them through this kind of horrible kind of 2021 situation. Obviously, companies expect to lose money in 22. It'll get them through that. So hopefully they can start flipping to profitability in 23. And also they can simultaneously not only withstand those losses in the short term, but also be able to reinvest into the business with, robotics, automation, those sorts of things, which are huge and will help out the company get to profitability much, much quicker. So that's just one of many reasons, obviously, why I'm invested in the stock, is just being in that sort of financial position. You don't want to be in a money-losing company if they're in a very, very weak financial position and they don't have much cash around, because a lot of times you need that cash buffer to get you through that tough time, to get you over to the other side. One of the beautiful things that, back in the day that Elon was able to do at Tesla is he could raise money in a snap of his fingers, right? And that's just phenomenal, because the company needed to raise, we're talking about Tesla raised so much money, probably $10 billion plus over the years. And, obviously Tattoo Chef doesn't need to do that. It's a totally different business model, but it's nice to have either a CEO in place who can raise money, or if you're a company like the Chef, be in such a strong financial position that you can withstand those losses and get yourself till you get to profitability.
Included $4.3 million increase in accounts receivable resulting from increased revenue, a $10.7 million increase in inventory, a $2.1 million increase in prepaid expenses, mainly due to the increase in prepaid advertising expenses, and a $4.6 million decrease in accounts payable, accrued expenses, and other current liabilities. Capital expenditures increased to $63.8 million from $7 million last year, and primarily reflected that we used $16.9 million to purchase property, plant, and equipment to enhance our production processes and efficiencies, as well as $46.9 million to complete the 2 strategic business acquisitions in 2021. Turning to our outlook for 2022, it is important to understand that we are continuing to operate in a challenging inflationary environment, which is most evident in our freight and container costs, which are incorporated in our cost of goods sold, while managing through certain supply chain constraints. With that in mind, we expect 2022 annual revenue of $280 to $285 million, driven by a combination of new product introduction and a significant increase in retail distribution via new relationships and further penetration of existing accounts compared to 2021, supported by capacity acquired in 2021. With respect to the cadence of this growth, we expect that the first quarter of 2022 will benefit from $6 to $8 million of advertising in relation to MVM sales that are not likely to recur later in 2022. This increase assumes no material deterioration in general market conditions or other factors related to COVID-19 trends. Marketing expenses for 2022 are expected to be $27 to $32 million. We anticipate capital expenditures of $20 million, with investments to include additional automation machinery as well as robotics. This will decrease labor, improve yield, and increase capacity and throughput in the same manufacturing footprint. Thank you all for your attention, and I'll turn the conversation back to Sam.
Are we ready?
And we'll open up the call for Q&A.
Great. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Our first question is from Brian Holland with Cowen and Company. Please proceed.
Yeah, thanks. Good morning, everyone. If I could start with just thinking about that 2022 revenue guide. Obviously, you exit the year at about a $200 million run rate. You're guiding to 280. Revenues have been fairly range-bound throughout the year. I know there's a lot of distribution gains coming and in the review as well that you picked up. So just thinking about the cadence of the year on the top line, when do we expect to see that inflection towards a run rate that would point closer to that 280 or so range?
As we stated, Q1 will be higher in revenue based on the MVMs that we have already set up for the first quarter. You'll start to see that run rate in Q2 and Q3. And it's really us having all of that retail business throughout the entire year. Remember that a lot of the stores that came in were in Q3 and Q4. And so we'll continue to see that. Matt, do you want to add anything to that?
No, I would agree with that. I think that, obviously, Brian, the new distribution kind of started coming into effect, obviously, in the third and fourth quarter of 2021. And so what I would, like Stephanie said, you'll see that run rate clearly in Q3 and Q4, not only with the overlap that we're going to get from the new business that came on in 2021, but also those new gains that we're starting to see as customers are resetting with the commitments we've gotten so far this year.
And just to clarify, so we got the commitments in 2021, but the sales don't hit until 2022. Is that the way to think about this?
Yeah, yes. And usually a lot of early, end of Q3 or end of Q4, start of Q1, resets are happening now, and you'll start to see that product shipping in Q1, Q2 for the Q3, Q4. You'll start to see the full revenue benefit of that.
Okay, understood. And then if I just move down to the gross margin, so it seems like if my math is right, based on the promotional allowance, I believe, Stephanie, that was about an 800 bips gross margin hit. But that is one time, so that's not a factor as we look at the 2022, like that gross margin should snap back. Did I hear that right?
We'll see snapback. What happens when you first build that accrual is you take that hit up front for the promotional allowances, and then you're looking at differences between it and promotional spend that we're seeing. We happen to know that there were sales that occurred in Q4, that the promotions were moved earlier into Q1 2022. And so we wanted to make sure that we had that fully accrued for. We will continue to promote the brand in a way that is healthy and competitive, but that is certainly higher than we expect it to be for Q1 2022 and into 2022.
Understood. And then I guess last one for me, and I'll pass it on, is just thinking about your balance sheet position and capital needs. You've got $90 million of cash. You've given the gross margin guidance. We know what the marketing spend is going to be. So you got $30 million of marketing. You got $20 million of CapEx. There's obviously other operating expenses there, and then whatever the working capital dynamics might be. Just help us think about sort of your position there and the likelihood and the optionality you have on needs for capital and sources of capital over the next 12 months.
So one of the nice things and fortunate things that we did last year is we utilized cash to fund the acquisitions. And so the cash burn looks incredibly high for 2021, whereas when we roll into 2022, we don't have any real debt on the balance sheet. I believe that there's 0.7 million. And so we have the opportunity to finance the equipment, and that's what we're looking into right now while interest rates are still low. We believe that we have enough cash at this moment in time in order to make it for the next couple of years, even with the inflationary pressures that we're facing today. On top of that, we expect to start seeing profitability in the back half of 2023, and obviously that certainly helps with cash.
That's big. Stephanie just said, the CFO of the company, that she expects profitability to start hitting in the back half of 2023. So yeah, pretty much in line with me. Like I said, I'm expecting at least some profitable quarters in 2023, and the ones that, if they have any quarters in 23 that aren't profitable, I think they'll be very slightly not profitable. So yeah, we'll leave it there.
Okay, thanks. I'll leave it there. I appreciate the color. Best of luck.
Thanks.
Copycat.
Our next question is from Rob Dickerson with Jefferies. Please proceed.
Great. Thanks so much. I just had a question, I guess, kind of on operating expenses / the step up in the marketing expectation for the year. I guess, kind of if we go back kind of 2020, right, and we think about, kind of where we thought the business could be, let's say in 22 or 23, right, that's changed for a number of different reasons. That said, SG&A is obviously increasing at a kind of much faster rate than I think we would have expected, and, faster than we're seeing sales. So I'm just curious, as you kind of thought through the budget for 22, do you just basically say, look, it's essentially imperative for us, to be supporting the brand, especially the new innovation, to make sure that we're getting the velocity. So we need to continue to lean in to take those expenses up higher relative to sales growth, which is obviously putting more pressure on your margin outside of anything that's happening in COGS. Just kind of curious as to, and I'm asking, too, because, if we think about kind of what the implied EBITDA margin is probably for 22 relative to what we thought it would have been 2 years ago, it's obviously much lower. But it's not just because of COGS, it's actually because of a much faster rate in SG&A spend. That's my first question. Thanks.
So I think,
holy smokes, that was a long question. I just want to state that. I mean, I got this on 1.5 speed, and that dude just asked that question for like an hour. Holy smokes.
Part of what we've seen in the increase of SG&A has also been the build-in infrastructure. One of the bigger hires that Sam discussed earlier in the call is we hired a chief operating officer. And as you might recall, it is one of those things that I was pulling double duty there for a while, and we understand the need to have me focused in one place and have somebody focused on operations without that overlap so that we can continue to run this business as we grow. We've also made several additions to the infrastructure within, not just for what we need last year, but really looking forward to the staffing needs for our growth in 2022 and 2023, and ensuring that we had time to pick the correct candidates, have them trained, have them understand the way that Tattooed Chef works, rather than coming in too late for those items, like SOX compliance, that is going to be incredibly important to us in 2022 with the growth in accounting and the need, honestly, just to step up that department. We'll continue to spend on marketing and advertising because it's important to the brand. And even our budget, where it's going to be at for 2022, we don't feel is near where some of our competitors are. And we feel that it's important that Tattooed Chef become a household name today rather than waiting until inflation resides or, issues throughout the world resolve themselves.
Okay, fair enough. But I guess
I agree with that. You could be waiting a long time for that stuff. You can't wait on the world, man. In life, you got to make the moves. You stay waiting, you're going to be waiting forever because it's always going to be crap out there. That's just the bottom line with that.
But then from here, as we get through 22, kind of that, incremental rate of spending SG&A starts to kind of balance out, right? That starts to normalize from here. And then that's where you get the incremental operating leverage and kind of back half profitability in 23. Is that fair?
Yes. Hey, Rob, this is Sam. I think also as far as the marketing spend, one thing that, when we first started a year ago, one thing was that people looked at is they wanted to get more comfortable with the brand diversification because we were concentrated in club. And club could be, it's club. It's a different world than traditional conventional retail.
If anybody's confused about club, he's talking about like Costco, Sam's Club, those type of stores, like warehouse stores, BJ's,
What people wanted from us is they wanted us to get that distribution into conventional retail. And conventional retail costs a lot of money. Like we built the brand in club, and you could do it with a pretty not aggressive marketing spend. But once you get into this conventional retail world with this national distribution, it takes a lot of money. But it is really where the value comes in once you start getting that distribution and that all over the country that we have now. So, it is a big spend as far as I'm concerned, but it's exactly what we needed to do to really build this brand for long-term growth opportunities, and it's happening. That's what people wanted us to do, and that's what we did in 2020-21. We got into almost 14,000 supermarket chains with Tattooed Chef brand. It's happening, and it's
absolutely, Sam. That's exactly what I wanted you to do, man. Company's in a great position to become a food giant this decade. And, you can't become a food giant if you're just in Costco, Sam's Club, and warehouse stores. Like, it doesn't work like that. You need to be everywhere. You got to be in all the big grocery stores. That's the bottom line. Otherwise, you're just going to be a niche food company, which you could be a niche food company and, be profitable and those sorts of things. But I'm not in this for that sort of opportunity. If I wanted that type of company, like I said, I would just buy some traditional food company that has hardly any growth, but is profitable, right? I'm in this one because I believe they're a game-changing company that's going to be like a $5, $10, $20 billion market cap. And you're not going to get to those type of ranges if all you're in is Sam's Club and Costco. You need to be in all the food stores, and then you got to go international after that.
Business, and it's exactly what the goal is.
Okay, fair enough.
Rob, this is Matt too. Just, we had no insights department, right? We had nobody doing, insights to help to support the relationships that we've established with, key retailers like Target and Kroger and, obviously Albertsons, Safeway, even Walmart for that matter. And so as you evolve the business, we know that to support the long-term longevity of our existing business and, how we are managing our velocities and our promotional spend, we needed to invest in an insights department and data, right? So, we've got more robust contracts than we had at even the start of the year with Spins. We've had to invest in insights contracts with Kroger at a level that are different than probably what we expected at the start of the year because our business is growing with them. And there's expectations on their side to partner with them to drive insights as an up-and-coming brand partner. So, I think those things are in place now. We're going to be able to leverage that insight and that information to continue to grow, but I don't see kind of further needs for that in the future as we continue to shift this mix towards traditional grocery business.
Okay, yeah, that's all extremely helpful. Really appreciate it. And then just quickly, I think Mr. Holland asked the question.
It's very important, you hear something like that. Kroger is no bigger than Kroger when it comes to a grocery store brand. The fact that Kroger respects Tattooed Chef on a level where they understand this is going to be a brand that's not just up and coming, but it's going to be around, and to invest with them. It doesn't get bigger than that. It doesn't literally if you want any confirmation on if this company's going to be around and grow to something much bigger, when the biggest grocery store chain in all the United States of America, gives you that sort of respect, it's just it's on another level. That's them basically saying we think you're going to become a food giant and you're going to have a ton more products in our stores in the future. Not you're going to be some niche player over here with 6 SKUs forever. The only way Kroger gives that type of respect is if they're pretty confident you're going to grow into that company that all of a sudden you have 10 products in their store, 20 products in their store, 40 products in their store, okay?
My apologies, I don't fully get it. So I was trying to ask again, just in terms of the cadence of the year, right? I mean, it kind of sounds like what you're saying is, you're still in some promotional flyers, let's say, maybe on the club side in Q1, and that should help lift revenues a little bit if we, think about, sales, versus Q4. And then as you get some of the new distribution shelf resets in Q2, Q3, it steps up further from Q1. That's the first question. And then just anything in terms of cadence on the gross margin side, given kind of where Q4 came in. And that's it. Thanks so much.
So we expect to see increased gross margin, obviously, from Q4 into Q1 2022. And then I believe that we will start to pick up throughout the year. I think where we will start to see the effects of automation will really be Q3 and more so in Q4. The automation doesn't occur within a facility all at one time. It's a very planned procedure. In Paramount, we have 5 different production lines, and obviously we would need to go through line by line in order to continue manufacturing and continue to make sure that we have products on the shelf.
Okay, fair enough.
And then,
sorry.
And then on the quarterly revenue cadence, again, I mean, we still have this disparity of these promotional activities that we have in Q1 and Q2 that will be hitting, obviously with the club channel. I think that what Rob was asking is when do we expect to see the run rate of more of a normalized business to get to that 280 to the guidance in revenue, and that will start to happen in Q3 and Q4 because of the diversification of the business moving more towards grocery and food and away from club.
Okay, sorry about that. Thank you so much. Appreciate it.
Thank you.
Our next question is from George Kelly with Roth Capital. Please proceed.
Morning, everybody.
So basically, simplest way I could put it is Chef's expecting a much stronger back half of the year than front half of the year, which makes sense. Like, it shouldn't just be that way this year. It should be that way in all future years as well. Like, as a company continues to grow, Q3 and Q4 should always be stronger than Q1, Q2. That should be a pretty normal environment.
So two questions for me. First, another question on the revenue guidance for 2022. Curious if you could talk about the ramp with these newly acquired facilities, and can you quantify the amount of revenue that you expect to come from them as part of your 2022 guidance?
So let's talk first about New Mexico. New Mexico has started to ship products under the Tattooed Chef brand, and the products are actually on the shelf in Kroger today. And there were a few burritos that were taken in handhelds, and we expect to see that continued growth out of New Mexico. And you'll probably really see that hit the market. Matt, when do you think that'll be?
Most likely, it'll happen in March and April. April and May will be the majority of the new products hitting.
In the existing customers,
yes,
correct?
Correct.
And then, as we've talked about bars, the bars were shown to everybody at Expo West, which included buyers and various people in the industries. And so we're expecting Belmont or the Ohio facility to really be looking at Q3 based on timing and resets and things like that. The facility is ready to go. It's just a matter of getting the orders, and Matt and his team are working very hard on that. We'll continue to see that expanded growth throughout the year. And I think that it's really a matter of, as Matt has said, Q3 and Q4 to really see that start to drive home out of those facilities. As far as guidance on the new facilities, we know what the revenue can be out of those facilities. In New Mexico, you're looking anywhere between 200 to 250 million based on capacity. Ohio has a lot of capacity.
Wow. 200 to 250 rev they think they can do just out of the New Mexico foods facilities. That's insane. Whew.
We're looking at probably, somewhere in the range of 100 to 150 million, but we don't expect that for the next 2 years.
Wow. And then also long-term, they expect, or not long-term, but just over the next couple of years, they expect to get in Belmont, the confections business and where they're going to make the bars and all those sorts of things, to 100, 150 mil. Those are pretty substantial numbers. And mind you, that they still got their massive facility, the main one, right?
The beginning of it, and as timing phases in and distribution for grocery retailers still faces some challenges.
Something Stephanie said very interesting the other day in that presentation, that conference, whatever you want to call it. She said they can get to, I believe it was 700 mil rev with no increase in more production facilities. So, yeah, that's good. That's really good.
On that, probably when we report Q1 earnings.
Okay, that's helpful. And then last question for me, the $20 million that you're spending to automate some of your facilities, does that get everything now kind of up to date and where you want it to be, or do you anticipate there being additional investments to bring that automation to maybe Belmont or New Mexico next year? And then secondarily, on the same topic, what's the ROI? How do you think about that $20 million? And like, as that all that automation is kind of fully implemented, what kind of gross margin pickup should you see? And that's all I had. Thank you.
Thank you, George. We look at the $20 million capital expenditures to really bring the existing facilities and the new acquisitions up to speed. There will always be some expense in CapEx, but I don't consider it to be significant in coming years for those facilities. With the increases, and what we're looking at is it's, again, all about production capacity. And so on a burrito line, you could turn around and have cut down probably 6 to 8 people from the line and produce twice as many burritos as you produce today. And so when you're talking about increases, you're talking about fixed overhead and semi-variable overhead going over a greater number of products per shift and per day. And so the increases can be substantial. We expect long-term gross margins, remembering how we account for finished good freight above the line and in our cost of goods sold, to really be in the 25 to 30% range, but that also includes some diversification into the other areas, such as refrigerated and ambient.
Understood. Thank you.
We have reached the end of our question and answer session. I would like to turn the call back over to management for closing comments.
Thank you for your participation today. 2021 was a milestone year for our company, and we are very excited about our future. On behalf of all of us at Tattooed Chef, I thank you for your continued interest and support. Have a great day.
Thank you.
All right, so let me give my closing thoughts here. So, first off, everything's on pace, revenue-wise, top-line-wise, branding wise, getting in retailers, getting SKU expansion, getting into more product categories. Everything's on pace for that. Love that. Also, they've put in place a management team now that is ready to take this business into the future in 2022 and beyond. They've got now everybody in the accounting departments they need. They've got a full executive team now really built out in each individual department, rather than like, people doing double duty and stuff like that, right? Where like Stephanie for a while was like COO and like CFO. That's like, for a company that's scaling to hundreds of millions of dollars, like Tattooed Chef's probably going to do 300 mil in my opinion, if not more than 300 mil in my personal opinion in 2022. You're talking about that type of rev. You got to have a CFO who's just dedicated to being a CFO. You got to have a COO who's just dedicated to that. You can't have, trying to run two, not with a business that's at those type of run rates. Maybe if you're running like a $3 million business, that's fine, okay? Or maybe even a $30 million business, but not like a $300 million business. You can't do that. And so they got the team in place now. Love that. Last part I really love is that they're putting in place everything now to make this company have better margins and get them much closer to profitability over the coming quarters, essentially. When we talk about robots, when we talk about automation, when we talk about the cost savings, when we talk about cold storage, all those sorts of things. And then over time, freight and those logistics costs will come down as a percent of revenue as well when it goes from this massive headwind to a tailwind. So everything's kind of lining up perfect for them, in my opinion, where it's going from kind of like the perfect storm against them to kind of like the perfect storm with them starting, over the coming quarters, and especially as you get into 23 and beyond. So, everything's right on track. So I'm extremely pleased. I can't be more of a happy shareholder than I really am, and this just continues to be a stock I'll accumulate more and more ownership in throughout the year, and just build my ownership position bigger and bigger and bigger in this one. And I don't know when I'll be done buying the Chef, but I just this isn't a company I can just not continue to buy right now. I just got to continue to accumulate shares because I know where this company's going over the long term. Very, very confident in that, and I'm not going to miss this sort of opportunity. So that's about it. Hope you guys enjoyed this. This was a beast video. Let me know if you enjoyed it in the comments section. I appreciate you guys joining me. If you made it this long, then you are really a dedicated TTCF bull. I can tell you that much, or you're very, very interested in this company. So much love as always, guys, and have a great day.